Great. Thank you very much for joining us this afternoon for our quarterly webinar. You will hear from three of our professionals here at Cambridge Trust Wealth Management today. But we truly appreciate the relationships we have with all of our clients and friends, so thank you for joining us. This will be recorded, so you will have an opportunity to hear anything that you missed. You'll receive a link shortly. 2022 was a very difficult year in the investment markets. Both equities and fixed income were negative. It's been difficult. We certainly want to review some of what happened in 2022, but going forward, we hear interest rates going up, inflation skyrocketing, recession or no recession. Today, you'll hear from John Trainer. He is president of Cambridge Trust Wealth Management, Connecticut, and former chief investment officer at People's United. Chris Lucas, senior portfolio manager and first vice president, and Will Fleming. William is a relationship manager. He's a vice president and also a certified financial planner. So, John, can you make some sense of 2022 and what we're looking at in 2023?
Well, I will certainly try, Susan, and thank you very much for that introduction. What I'd like to do before I hand off to Chris and Will is to walk through a few slides that discuss some of the economic data, all this news that we all get every day on the economy, on inflation, on employment. Try and make some sense of it, as Susan said, and then show you how we're taking that data to try and build portfolios for our clients. So if we go to the first page, you'll see a slide that we put together that describes really the role of the Federal Reserve. And if you can read that quote, you'll see that the role of the Fed, much like a party chaperone, is to take the punch bowl away when the party gets too ebullient. When we get too excited about the economy, when inflation starts to bubble up, the Fed's job is to tamp things down. Now, the Fed has taken a real prominent role in the headlines today. But if you watch CNBC or if you read the morning paper, there are really three dates that everyone is talking about with regard to the Fed. The first date is, when will the Fed stop raising interest rates? Just not even 12 months ago, the Fed started raising rates in March last year when we were close to zero, and we've had a tremendous increase in rates. So when will the Fed stop? Next, it's how long will the Fed pause? Chairman Powell has said that he's going to raise rates and he's probably going to sit there for a little while. So how long that time frame takes, that's very important to us. And then when will the Fed eventually start cutting rates? So we'll talk about that. We'll give you a sense of what our thinking is. And then hopefully, as we move forward, you'll get a sense of how we're building portfolios in, this tumultuous environment. If you go to the next page, it's a great chart that essentially boils down what we think are the key issues. Number one, inflation is too hot. If you saw yesterday, we saw the CPI come in. Yes, it was down, but it was not down as much as we all expected. Inflation, even though it's come down from the highs of mid last year, it's still a problem. It's still a problem in a lot of areas. So the Fed is remaining vigilant. They're remaining vigilant. And yesterday's data told us that, the Fed is probably going to have to stay tough for a little longer than what most investors expected. And if you take a look at the economy, we actually grew very, very nicely in the fourth quarter, 2.9%. Just based upon the momentum in the economy currently, most analysts are expecting the economy in the fourth quarter, where we are right now, to grow north of 2%. So again, the economy, even though the Fed has been trying to tamp down the economy, we still have a good head of steam. So again, what the market is telling us is that the Fed has more work to do. Well, where are we seeing this? We're seeing it in employment. We saw tremendous job growth in the month of January. Yes, there could have been some seasonal adjustments, but the economy was pretty strong in the month of January. That 3.4% unemployment rate that we saw last month, you've got to go back to 1969 to see the last time we were at 3.4%. If we ever go to 3.3%, you've got to go all the way back to 1953 to see a time when the economy was that strong, that unemployment was that low. So we are in uncharted territory when it comes to the demand for labor and the strength of the underlying economy. So let's talk a little bit about inflation. If you go to the next page, there's a chart that I really like looking at. What this shows you is not just that the blue line is the overall inflation rate. What we've done, though, is we've broken it down into its components. And if you take a look, you'll see that goods inflation, what we all pay for gasoline at the gas station and all the different things that we buy, that's actually starting to moderate a little bit. So that's what's helped bring the inflation rate down. If you take a look at that core services, which is that green shaded area at the top, you'll see that as the economy has rebounded from the pandemic lows, services have really gone through the roof. That is what the Fed is most focused on. In commentary after the latest inflation report, Chairman Powell specifically noted core services, that is what he is very, very focused on. So naturally, that's what we're focused on as we think about the markets. If you go to the next page, you'll see why services inflation has been so strong. The blue line on the chart that you're looking at, that's goods inflation. All the stuff that we buy, the stuff that we purchase, whether it's a car, whether it's a TV, whatever, all of the goods that we purchase. The orange line are the services. When we go out to dinner in a restaurant, when we take a trip, when we fly in an airplane, those are all the services. And you'll see historically, those two lines have tracked fairly well. We'll take a look at what happened during the pandemic. Well, we couldn't go out to restaurants, so the orange line was dramatically impacted. What we did was we bought stuff, and you'll see that blue line jumped dramatically above where it should have normally been. As the economy returns to normal, those two lines have been coming together. But what you're seeing is, as we spend less on goods inflation has come down. As we spend more on services inflation has come up. So we think the pressure on services inflation will continue as we move forward. Hopefully, when these two lines come together, inflation pressures will moderate, but we see that pressure remaining for a little more time to come. If you go to the next page, what you'll see is a chart, and there's a little personal history here. This chart goes from 1979 to 1983. Now, I graduated college in 1982, right in the middle of this chart. So let me talk to you a little bit about this. Back in 1981, we all know that Chairman Paul Volcker, was trying to bring inflation down. It was dramatically. We all remember the tremendous inflation that we saw back in the late 70s. Well, he started to raise rates. We had a recession. What he did was he took his foot off the brake a little bit. Eased up on the severity of the interest rate increases. The economy rebounded, and what he had to do was come back a second time and raise interest rates and really crush the economy. So what we had was a double dip recession. Everything that Chairman Powell is doing right now, one of the reasons why we think he's going to stay long with the rates that have risen, is we think he's trying to avoid a double dip recession. He does not want to go through this. If we do have a recession, he wants it to be hopefully shallow, a soft landing, but a soft recession, and then the economy can rebound. So avoiding what happened in the early 1980s is something that he certainly wants to avoid. And as somebody that was a college grad during this time period, I certainly hope he avoids the double dip recession. If you go to the next page, what we'll do is we'll take a little bit of a look at the employment market. All right, we talked about inflation. Now let's talk about employment. The red line on this chart is the overall labor force. Just about everybody on this call, unless you're in grammar school or you're retired, you're part of that labor force. The blue line is the participation rate. And you'll see that's been coming down gradually since the turn of the century. A lot of that is due to demographics. We've got a lot of baby boomers that are retiring. So the participation rate has been coming down. It took a real dip back in 2020, as can be expected. We had a lot of layoffs, unfortunately. What we've seen as the economy rebounds, we've had some great news. Labor force participation has increased. That'll take a little bit of the pressure off of wage inflation, take a little bit of the pressure off of companies. But what you're seeing is that companies, whether it's a big business or a small business, they've become much more creative in how they hold on to employees. You know, maybe we have to be a little flexible and hold on to people that might be thinking about retiring. Maybe we have to be a little bit more creative and offer some more training to bring young people into the workforce. But what it's doing is you're seeing wage rates go up, but you're also seeing businesses be much more creative with how they bring their workforce together. So any news on that blue line moving up is good news. We want to see that blue line move up because it's only good news. People are coming into the workforce and they're earning good incomes. If you take a look at the next page, you'll see some more information about unemployment. This chart talks about where we are right now. We're in the midst of a tightening cycle. And look at what happens to the unemployment rate during a tightening cycle. It actually declines. In every one of the tightening cycles that we've had over the last several periods, unemployment has gone down. This is a good thing. This is one of the reasons why the Fed is trying to slow the economy. The markets are strong, the economy is strong. People are bringing, the unemployment rate is declining. So we're right in the midst of this. So it's normal for unemployment to actually decline while the Fed is raising rates. If you take a look at the next slide, this is the other side of that. Once the Fed ends their, we talked about the 3 dates. Once the Fed stops raising rates, all right, so the tightening cycle is over and they're in that pause period, look at what happens. That's when the bad news on unemployment takes place. So even though it's the good news, and we saw the good news in January, and we're expecting a good employment report in the month of February, we are preparing ourselves for the fact that we're probably going to see some poor employment numbers once we get into that pause period, once the Fed stops tightening. So we're preparing ourselves for this, and we're taking a look. What's the impact on consumer spending once we get into this kind of an environment? It'll have a big impact on our equity portfolios. If you go to the next slide, you'll see a little bit of information about equities. You can go to the next slide after this. This is a chart, as Susan mentioned earlier. The last few months have been pretty rough in the equity market. This is what took place in 2022. You'll see the S&P 500 during the first quarter and the second quarter declined pretty sharply. In fact, if you read the comments there, you'll see it was probably the roughest market that we've had in the last 50 years. Very, very tough first half of the year. If you look at the second half of the year, we were up, we were down, we were up, we were down, and that pattern has continued. The reason for that is, as we discussed earlier, as the Fed has started raising rates, a lot of investors are wondering, when will they stop? Gee, will we have a recession? Will we not have a recession? And as psychology ebbs and flows, that's what's happening to the market. So every time Chairman Powell comes out, he's very, very tough on inflation and talking about being tough for quite some time. That scares investors, and we move back down. We think we're going to stay in this sort of an ebb and flow type market for quite a while to come, until we get a clear view on the Fed policy and the impact on corporate earnings, on the overall economy. We think we're going to be in a similar market to what we've seen now. Now, this is a chart that shows you last year. And I will tell you that there are probably people out there that will tell you they can decipher every single wiggle, the ups and the downs, and be in stocks on this day and be out on that day. That's not a game that we'll ever play. I don't know anybody that's that smart. What we try and do is take a look at what's the big picture, where do we think the markets are going, and how do we build portfolios from there. So the next two slides really talk about big picture type events that we're keeping an eye on. If you go to the next slide, it talks about, the difference between growth and value stocks. And if you read the Wall Street Journal, or if you take a look at how you're invested in your 401k, if you've got a 401k, usually stock funds are divvied between growth and value. And on this chart, value does well during the green periods, growth does well during the green periods, and value does well during the white stages. We've had a tremendous run in growth stocks. We all know that tech stocks over the last 10 years have done very well. If you take a look, you'll see, it looks like value stocks have started to do well. One of the things we try and do is not, again, you're never going to capture every little wiggle, but just to understand the big picture. Is there a shift going on in the marketplace that we should reflect in portfolios? So this is something that our equity team is taking a look at all the time. If you go to the next page, you'll see a similar chart that talks about how domestic stocks and international stocks do. The purple area there, if I can say that that's purple, is when the international stocks do well. The gray area is when domestic stocks, US stocks, do well. You'll see the gray area for the last, since really 2006, has shown that domestic stocks have done very, very well. Well, one of the things we need to consider is this a point when we should be thinking about that domestic versus international allocation in portfolios? Again, what we're trying to do is not capture every wiggle, but just take a look at the big picture, understand what's going on. You've heard from Dave Lynch, our Chief Investment Officer, and a lot of members of the investment team over the last several calls, that building good portfolios and remaining defensive in this kind of tumultuous environment, as we've just discussed, makes a lot of sense to us. So we're going to continue with that strategy until we see the bigger trends go forward. So I'm going to stop there, and I'm going to hand it off to Chris Lucas, and he's going to give you a little more information about some of the trends that we're seeing.
Perfect. Thank you, John. Good afternoon, everybody. Today I'll be discussing deglobalization, a term many of you are familiar with, and the potential impacts on inflation and markets. We go on to the next slide here. Before we get into deglobalization, I want to start with globalization. How do we get here? And really, the globalization push, was marked after the Berlin Wall fell in 1989. The Soviet Union collapsed, and really there was only one major superpower left, obviously the United States. That had, big ramifications from defense spending, which was cut across the board. You'll remember the peace dividend, so countries could invest in other areas. And companies were free to seek out the lowest cost of labor and energy without really thinking about borders. Outsourcing became even more popular. China, obviously, a big beneficiary of that move. And if you think of energy, you think of the current mess in Europe. The Europeans becoming addicted over the past couple of decades on cheap natural gas from Russia that was piped in. So those are big changes that occurred during the globalization push. And then you think of companies like Walmart, the importation of deflation, pushing consumer prices down. American, manufacturers struggling to compete with manufacturing over in Asia. A few different significant dates here. 1994, NAFTA was established, a free trade zone between the US, Mexico, and Canada. 2001, very significant, China joining the World Trade Organization, WTO, really accelerated the globalization push. And then a very interesting point here, in 2013, the last US heavy armor unit left the continent of Europe in Germany because of the lack of a need to have that type of a unit in the area. So we've come a long way since then. So let's go on to the next slide and then talk about deglobalization, where we are now. A more dangerous world, many perceive it that way, especially after the last few years we've encountered. And we believe that this deglobalization push by Western powers, starting with the United States, is going to have an inflationary effect, especially on the shorter term. And it all started really with the pandemic. We saw how vulnerable global supply chains were, whether it's pharmaceuticals, whether it's basic essentials, the slowdown. You remember seeing the ports in Los Angeles with 60 ships waiting to dock, and the craziness that ensued. So we saw our vulnerability from a supply chain standpoint. A more assertive China, very worrisome to the US and Western governments. Think of Taiwan, 75% of advanced semiconductors, which is really the lifeblood of the global economy, comes from Taiwan. Think about most recently with the balloon incidents, ratcheting up of rhetoric. Our Secretary of State canceling his trip to the country. And also before that, if you go back to last year with Speaker Pelosi visiting the country and the uproar by the Chinese. And so lastly, but not least, the Russian invasion of Ukraine has thrown us into an energy supply crisis we haven't seen in quite some time. Obviously, prices have significantly increased. And thank God we had a mild winter in Europe and also here in the States, or things would have been quite worse. And so, what does this all mean? I think if we're looking at deglobalization, it means more defense spending. It is no longer the U.S. And as the lone superpower. China's right there with us at this point. So we expect to see more defense spending because of that, and also the Russian hostilities. And also, for national security and other reasons, we're going to see additional manufacturing move to the States, move to friends. You've heard the term friendshoring. And a couple bills that passed last year, the CHIPS Act, which really focused on facilitating a semiconductor industry in the States and fostering that economy here. Again, with our friends in Europe, and also the Inflation Reduction Act to foster the electric vehicle industry, and also batteries, very significant. So on to the next slide here. I jump right into defense spending increasing. I think it's pretty well known. On the left-hand side here, you're looking at this chart of NATO countries that it's expected NATO countries to spend 2% of GDP in defense spending. Most countries do not meet this. The United States is one of them, along with Greece and others here. But we are seeing countries pledge to spend more, and we are seeing that in actual dollars being spent. You look on the right-hand side, one of the worst culprits is Germany, not meeting that goal. They have announced spending increases. But you look in aggregate, if every country in NATO did spend 2%, that would be $83 billion in defense spending increase on an annual basis. This is down from 4 years ago, about $115 billion gap. But that's definitely something we're focused on. And some significant events that have happened in the defense side of things. Sweden and Finland, who have been neutral for years, have resisted joining NATO, not to inflame tensions with Soviet Union / Russia, have now applied. It looks like Finland will most likely get in before Sweden, as Turkey is holding that up. But we do expect them at the end of the day to join at some point. And then also we're seeing the Japanese increase military spending, especially offensive capabilities, which is very significant in the Pacific area. And along those same lines, last year it was announced the AUKUS agreement between the US, Australia, and Great Britain, the sharing of nuclear submarine technology. Again, very significant event to counter the influence that China has in the Pacific. So next slide here. Now we're talking about stocks of crude oil, including the Strategic Petroleum Reserve, SPR. Last year, the SPR was utilized significantly due to the Russian war and sanctions, and the real just mess that supply became between trying to figure out if Russia was supplying Europe with natural gas and oil, but now Europe's not buying, how are we going to get it? So you saw natural gas or liquefied natural gas come from the States. You saw Russia start to sell more to the Chinese and to India, and all that increased in prices. That didn't happen overnight. And so the administration released about 37%, or about 220 million barrels of oil, to keep prices lower, in conjunction with other nations to fight the pain at the pump. But from a national security perspective, we're more vulnerable now than we've been in a long time. We're at the lowest levels in the SPR since 1983. And so, I know the administration is looking to refill that, but not at a price that is going to be inflationary. So next slide here, as we keep going on. Now, there's an energy transition going on. It's undeniable. And again, the Inflation Reduction Act was a big step forward to help the industry move in that direction, moving away from dirtier fossil fuels towards more reliable, less volatile, EVs. However, with that being said, we are seeing inflation in that space. And I use the Ford F-150 Lightning as an example because it came out with a price in early 22 of just over 41,000. We saw 3 separate price increases during the year for the beginning sale value of over 58,000. That's a 40% increase in less than a year. And really, Ford has blamed the components of the batteries. Lithium, cobalt, nickel, all key ingredients to producing the EV batteries. But every auto manufacturer are investing in EVs. And so, at least in the short term, this is going to be inflationary as we make this, energy transition in this deglobalized manner as we foster not only here in the US, but also over in Europe, Japan, elsewhere. That's going to be inflationary as we make that transition. On the next page, again, we're talking about semiconductors. If you read the Wall Street Journal a few weeks ago, they're talking about semis as being chips, being the new oil. It's that important to the global economy. And this is an example where Taiwan Semiconductor was already building a $12 billion plant in Arizona. After the Inflation Reduction Act came out, they actually increased that investment to $40 billion with a separate, more sophisticated plant. But what's really fascinating here is we're trying to reshore this. We're trying to bring manufacturing back. From a national security perspective, and we can't be wholly reliant on China for all the inputs that go into semis. However, if you look at this example, Apple has come out and said we're going to be one of the first buyers, and that's great. It's great PR for Apple. We love to see it. Great investment in the States. However, TSMC's come out and said these chips are probably going to be about 50% more expensive than the same chips produced in Taiwan. So again, inflationary. I'm sure over time those prices will level out as the expertise, the supply chains get set up in this country. But at least initially, this reshoring, this deglobalization will be inflationary. Next slide. And then in summary here, I think this is such a great chart to kind of take a look at 2 different periods of time here with the S&P 500, looking at price to earnings multiples. On the left-hand side, you'll go from about 1950 to the Berlin Wall falling in 1989. And the average multiple was about 13.8 times earnings. That was a period of higher inflation, higher interest rates, and more geopolitical instability as the USSR and the US were going back and forth. So it was a more uncertain, unpredictable period of time. After the Berlin Wall fell, when it was just the US, one of the lone superpower, it lower inflation, lower interest rates. You see the average price to earnings multiple increased about 19.5, pretty similar to where things are today, S&P 500. And so key here is, as investors and as we look at all this on our asset allocation team and our analysts and our equity strategies, look at this, is where do we go from here? We are in a multipolar world. There are 2 superpowers, the US and China. We know that things are going to be contentious, moving forward here. We do know we're going to have more domestic production of advanced manufacturing coming back to this country, and friendshoring, Mexico, Canada, our European allies, Vietnam, etc. Some of that will be inflationary, moving from lower cost production areas for national security and other reasons. So that higher inflation is likely. And I think really, boiling this down into John's earlier point, is our growth stocks and their significant outperformance versus value going to continue? We're under the opinion that the major divergence that we've seen, especially for the past decade, with 2022 being the exception, is probably over. That doesn't mean growth stocks aren't a good place to be. Apple's a growth stock. We love Apple. However, that divergence between growth and value is probably not likely to persist in this structurally changing global economy. On the next slide here, we're going to go 2 more slides and just wrap things up on 1 more slide. right here on tactical positioning. So I wanted to make sure I went through our current best thinking at Cambridge Trust right now, all else being equal. On a high level, for equities, we remain slightly underweight, neutral on our fixed income, and cash, we are slightly overweight. Money markets, are earning, roughly 4%, which is, far and away above what it has been for many years. And then really focusing on equities here, we have made a recent moving to neutral between the US and international. We had been overweight US all of last year, and then that was a recent change to downgrade the US and increase international. And really two main factors on increasing international. Really last year, for the most part, until the fourth quarter, the dollar strength was a real headwind for international. That has reversed as the dollar has started to weaken coming into this year and has continued. So that's been a tailwind for international. And also the divergence in valuations is very attractive for international stocks. And so it was no longer justifiable to be underweight. So we are neutral across the board. And at Cambridge Trust, we look at the world as 80-20, 80% US, 20% international as being our neutral stance. So you've heard from myself and John about the markets, the economy, the potential impacts from deglobalization, but that's really only half the story. My colleague, Will Fleming, will now translate our investment management piece into wealth management and financial planning. And I will now pass it over to Will.
Thank you, Chris. Good afternoon, everyone. As was stated at the top of the call, I'm a certified financial planner. I'm also a member of the financial planning team here at Cambridge Trust. Can we go to the next slide, please? And part of my role as a planner is to take everything that Chris and John just said with regards to the economy, with regards to markets, and to integrate that with the specifics of a client's personal situation. So taking into consideration things like their personal tolerance for risk, their time horizons, their goals and objectives, their family dynamics, their medical history, personal preferences, so forth and so on. And out of that, we're able to create a comprehensive financial plan with actionable next steps. Because at the end of the day, our clients want to know, what does all this mean for me? Given all this economic and financial data, what's the impact to my family and I, and how can we best take advantage of that information? So we're able to provide meaningful insights to those types of questions through the development, the implementation, and the ongoing monitoring of a financial plan. So I want to take a few minutes today just to go over the financial planning offering here at Cambridge Trust. I've been doing this for a number of years now, and it's my belief that everybody needs a financial plan. Everybody needs a plan for a multitude of reasons, but perhaps most important is that a financial plan provides a roadmap on how to get from point A to point B. And in doing so, it serves as a reference point from which we can measure progress over time. So as time goes on, we can gauge, are we on pace to meet a goal? If so, great. If not, it highlights the reason to make a change. And the financial planning process gives us the tools to analyze which types of changes or adjustments are needed to get back on track, or what might be most efficient to do so. And I think that approach is extremely powerful in all market cycles, but certainly, given the state of affairs and last year's markets, I think it's of particular importance when there's stress on our financial accounts. When markets are down and returns are off, not only does it put stress on financial accounts and our financial plan, it also gives us that uneasy feeling inside. What we don't want is to have a knee-jerk reaction or an emotional reaction to short-term volatility in markets, or have that kind of displace our long-term plan. So the ability to have to come back to your financial plan and reaffirm that the goals and objectives that you initially put in place are still current, they're still valid, and also that the strategies and plans that are in place are still supportive of those goals, that's extremely powerful, because it generally allows our clients to be a lot more consistent in maintaining strategies over time. And a higher degree of consistency leads to better outcomes. Could you go to the next slide? So the financial planning team here at Cambridge Trust consists of other certified financial planners. There's also attorneys, CPAs, accountants. We have individuals from both our fiduciary and our investment teams that we can pull from as needed, which really have a deep pool of resources that we could draw upon But we're also happy to work with outside advisors. Many of our clients have attorneys and accountants that they have worked with in the past. We're happy to work with them as well, because ultimately we see ourselves as part of your financial team. Our team begins the financial planning process simply with a conversation. So we just get to know you at a deeper level so that we can establish a baseline for your financial life. And this is just taking everything that you're currently doing, your withdrawal rates, contribution rates, how you're invested, what your taxes look like, so forth and so on. And we can project that out using financial planning software, 1 year, 5, 10, 30 years, whatever the relevant timeframes are, and see if we didn't make any changes at all to your plan, where does that get you? You know, are there any highlights? Are there any pitfalls that we should try to avoid, things to address? And then also what we can do, and this is really the benefit of this approach, we can create alternative scenarios to address what if questions or just to explore curiosities and concerns. So oftentimes people will say, you know, if they're in their working years, what if I retired 5 years beforehand, before my projected retirement date? Is that even possible? You know, what if I become disabled or die prematurely? What's the financial impact to my family? You know, what if I were to make a change to my investment strategy? What does that look like for, let's say, a legacy or an income goal? You know, what if the laws shift and now there's a difference in the tax law or the lifetime exemption amounts? What does that do to my estate plan? And so there are endless amounts of questions that we could ask, and we're able to model that into financial planning software and compare and contrast that versus your baseline. So we know if we're going to be making a change to your plan, is that going to impede or improve your progress towards goal? And it's having that level of clarity that leads to better decision making. Go to the next slide, please. So there are lots of different topics that fit under the broader umbrella of financial planning. Here we've listed what we believe to be the 6 fundamental building blocks of a core financial plan: cash flow analysis, tax optimization, wealth transfer, retirement planning, asset allocation analysis, and risk management. Truly, there are many, many different subtopics that fit under each of these categories. I'm not going to go over each one individually today, just in the interest of time. And I think that's a conversation best had as a one-on-one conversation with myself or someone from the financial planning team. But I will take this moment to say, if anyone on the call is interested in having a deeper dive, having a deeper, more detailed conversation about any of these topics, about building that financial baseline and exploring either concerns or curiosities within your plan, please reach out to someone on your Cambridge Trust team, your relationship manager, reach out to Susan Mortori-Baker, or reach out to myself directly. More than happy to have those conversations at a deeper level. My key takeaway for this evening is that the financial planning team at Cambridge Trust can build a detailed picture of where you currently are in your financial life. We can help to identify and fully define goals throughout your life. We can build roadmaps on how you plan on achieving each one of those goals. We can help with the transfer of wealth at the end of life. We're going to be making adjustments and suggestions all along the way, which adds to a higher degree of clarity in decision-making, a higher degree of consistency over time. And ultimately, this is going to allow you and your family to be more confident that you can live your best lives. Thank you, everyone, for your time this evening. And with that, I'll throw it back to Susan.
Thanks very much, Will. We do have the ability to have questions put into the Q&A at the bottom of your screen. I know we have one already. John, I think this one is for you. You covered unemployment rates. Do you think the low unemployment rate has to do with the people leaving the labor force?
Yeah, boy, that is a great question. And let me throw out just a couple of facts for you. Every day since January 1, 2011, 10,000 people a day have turned 65. That's when the first of the baby boomers turned 65, and it has continued without stop ever since. So absolutely, a big reason for the decline that you saw in that participation rate are people retiring. Now, it's very interesting. The St. Louis Fed, maybe about a year and a half ago, did a study. Because if you think back to 2020, I showed you that the participation rate really declined. They said that an extra 2 million people retired than would have normally been predicted by that, 10,000 people every day turning 65. And what they've estimated, and it's actually turning true, that of the 2 million extra retirees, about 1 million will come back into the labor force. They may not come back full time, maybe they'll come back part time, but bringing some of them back into the labor force is certainly great for all of us. But you hit the nail on the head. Part of the reason that the unemployment rate is so low, we've got a lot of people that have retired. We've got to figure out ways to get people back into the labor force. I made a presentation a few weeks ago to a manufacturing group, and half of the conversation was about, I've got to find out how I can interest, young kids to come into the manufacturing industry. So they're increasing training programs. They've got to figure out how to hold on to their older workers, so they're becoming more flexible. All these are great things. So as I said earlier, seeing that blue line go up, the labor force participation rate, that is only good, because it means we've brought people back into the labor force and we've been more productive, more creative with how we've been able to hold on to them. But we certainly need more workers, absolutely.
Great, thanks very much, John. Chris, here's one for you. Can you give some examples of tax strategies used by our wealth management group?
Yeah, sure. I think one of the things that was a big emphasis last year, in a down year, we make sure to go through every account, every taxable account, and look for any losses that we can, successfully harvest without, having impacts on the strategy going into the new year. And so what we're going to do is make sure that in a year where, the S&P 500 was down 18%, where we can reduce a tax liability, we're going to ensure that we do that. And that's across the board. So I think, especially coming off of a down year, not only for equities, but also bonds, we were doing tax loss harvesting, not just in equities, but also in fixed income. So I think that's a big key to successfully managing the tax issue. And we saw that fully employed in the fourth quarter of last year.
Great, thanks very much. Will, we know that Secure 2.0 made a lot of changes to IRA distribution requirements. Can you maybe address some of those, specifically the charitable distribution?
Absolutely. Yeah. Secure 2.0, 3 years in the making from the first iteration of the Secure Act. So it made a number of changes that are probably going to impact a fewer number of clients than the original Secure Act did. But to address the question, so the qualified charitable distributions, previously there was 100,000 per year that someone could take out of, let's say, their IRA, and instead of incurring a required minimum distribution that would be taxable to them, they could do their RMD amount, or up to $100,000 that would go to a qualified charity, and neither them or the charity would be taxed. And that usually started in the year that you turned 70 and a half. Secure 2.0 made one important change to that. The year is still remaining at 70 and a half, which is interesting because RMD age is actually moved out to age 73. So you can still do your QCDs at age 70 and a half, but starting in 2024, that $100,000 limit is going to be indexed for inflation. So we should see some incremental changes over time.
Great, thanks very much. John, a related question for you. Which elements of the Fed's preferred inflation gauge are most influenced by demographics and long-term demographic trends?
Well, and boy, that's a great question. Well, first of all, the Fed's preferred inflation gauge is, you'll see it. It's the PCE core. They're trying to take a look at the substitution effect that takes place, which you don't capture with the CPI. So it's more tied to GDP. But you'll see this again if you take a look in the Wall Street Journal, the PCE, and they take a look at the core rate. So they back out. And some of us will disagree with this, but they back out food and energy, and they just try and take a look at what's going on underlying. So that's what the Fed is looking at, that core rate, what's really taking place underneath the economy. Well, from a demographic standpoint, again, we've got an aging economy, an aging society. We know that. And one of the areas that they're focused on, remember I talked about that core services? Well, one of the big areas in the core services is healthcare expenditures. And from a demographic standpoint, healthcare expenditures are not going down. They're probably only going up. So one of the wrestling matches that the Fed has right now is they're trying to cool the economy. We'll probably see, as we discussed, we'll probably see unemployment go up, but the expenditures for healthcare are going to continue. Just because the economy slows down doesn't mean people don't have those expenditures. So there's a demographic aspect to inflation that is going to be very difficult for the Fed to heal, for the Fed to correct just with raising interest rates. So some of the solutions to inflation may actually lie on the fiscal side. You saw President Biden in the State of the Union address specifically talk about healthcare expenditures. That's to address that demographic component of the inflation rate. But boy, that is a great question, because it really hits home to what the Fed and the politicians are wrestling with right now.
And Chris, it looks like investors expect interest rates to stop increasing later this year. Do you think the Fed will actually cut rates this year, or will they hold at 5.25? What do you think the terminal rate will be?
Yeah, so I think that's a great question, and boy, I wish I had that crystal ball out there. I know we all do. So I think just in the past week, and I think looking at that the old line of the Fed being data dependent. I mean, we are getting data on a daily, weekly basis that is shifting the markets that price in rate increases. I mean, it is moving so quickly. So just over the past week, to John's earlier point on CPI, the CPI came down. It's the right trajectory. It didn't come down as much as we had hoped. And then today, we had a big retail sales number. Those are both going to point in the camp of the Fed continuing to raise interest rates and most likely holding at higher level before cutting. So I would say at this point, we're probably trending more towards 5.5%. And I don't think we see a cut this year. But again, I preface that with that's this week's news, and that's what we're pricing in today. This is such a fluid environment that the Fed, and they're very smart to do this, is taking this week by week and digesting this information before they make decisions. So I know that's probably not a concrete answer, but we probably don't expect it this year, and it's probably going to be a little bit more than what markets have been expecting for rate increases.
So John, what is the prediction for the S&P 500 at 12/31/23?
Well, again, even though, as Chris said, we do have, some reserves in the portfolio, we're still invested. We like the equity market. We're staying invested in the market. The last thing you want to do is say, okay, I'm in today and out tomorrow. So we want to stay invested. We think the returns will be positive once investors, remember I talked about those 3 dates, when the Fed stops raising rates, how long the duration is, and then when they start cutting. Once investors get a better sense for, okay, the Fed has done a good job, they've cooled inflation. We might not get back perfectly to 2%, but once we get a better view of where the Fed is going, we think we're going to see a pretty positive equity market. So we're positive longer term, but don't quote me on the day that will happen. I have no idea.
All right, I think we have time for one more question. Do you see that we have until the beginning of the third quarter to look at higher fixed income rates? So pretty much the same question. Is the Fed going to continue to raise rates? And what about long-term versus that 1-year Treasury is awfully attractive right now?
Yep.
Yeah.
Do you want to take that, Chris?
Yeah, I'll let you chime in, but I think as portfolio managers, to your point, Susan, we're kind of balancing out that attractiveness at the front end of the yield curve with, hey, we're still seeing rates, even though the yield curve's inverted, we're still seeing rates that we haven't seen on the longer end in quite some time. So we're balancing those two things and saying, hey, you know what? We're going to have more of a barbelled approach, and we're going to, take advantage of what the market's giving us. We're neutral duration across benchmarks, but at some point, whether it's the end of this year or into next year, they will cut, and you do want to, have some of those rates locked away. I mean, if you look at the yield curve just today, I mean, the 6-month Treasury was over 5%. So, very, very attractive rates on the short end, but also much more attractive longer end than they have been in quite some time.
Great. And Will, what does this do to your financial planning with rates where they are?
Yeah, great question. So, there's, I would say, no blanket answer to that, because the financial plan is unique to each individual's situation, their family dynamics, and what their tax situation would be. If you're looking for long-term growth, maybe you're less concerned with positioning of your bond portfolio. Vice versa can certainly be true as well. So, we really incorporate all of that into the conversation with clients to get a better understanding of what not only do they need from their goal perspective, but also what solutions might fit best and align with those goals.
Excellent. It's so important to integrate the investment planning with the estate planning to get the best results. So thank you very much. Thanks everyone for joining us today. Remember, you will receive a link so you can review the information that you heard from John, Chris, and Will. We appreciate your participation today and look forward to hearing from you in the future.